Welcome to Talk Tickers. If you have been scanning the financial wires recently, maybe looking at the Q1 2025 earnings season, you might have noticed something that looks a little like a glitch in the matrix. You have these major corporations reporting multi-billion-dollar losses. I mean, massive red ink that would usually send a stock plummeting.
Right. Total panic mode normally.
Exactly. Yet their stock prices are holding steady or even climbing. And their CFOs, they aren't apologizing. In some cases, they seem almost relieved.
It definitely looks upside down at first glance. If you just read the headlines, you see loss, miss, red ink. But what we are seeing isn't a glitch at all.
It is it.
It's the result of the most significant overhaul in corporate accounting for digital assets and, well, in U.S. history. We are talking about the FASB Accounting Standards update, specifically ASU 2023-08.
Which is a very, very dry name for a rule change that just authorized billions in paper wealth to suddenly appear on balance sheets, and I guess also authorized billions in paper losses to vanish just as quickly.
It's a complete 180 on how we scorecard these companies. For a decade, holding Bitcoin on a corporate balance sheet was an accounting nightmare. It was obscure, punitive, and it just confused investors. Now it's transparent, but it introduces a level of volatility that, frankly, most traditional investors are just not used to seeing.
Okay, so our mission today is to decode this shift. We need to understand why the old rules were effectively hiding value, how this new fair value standards works, and why it turns Strategy Inc., formerly MicroStrategy, into a company that posted a nearly $6 billion loss while being the undisputed king of corporate Bitcoin holders.
Let's get into it.
So let's start with the old regime. Because to understand why this quarter looks so weird, we have to understand the straitjacket these companies were wearing before. Before December 15, 2024, if a company bought Bitcoin, they were stepping into what I call a valuation trap. Why was that old method, the costless impairment model, so universally hated?
To understand the hate, you really have to understand the classification. For years, U.S. accounting rules, that's James, didn't have a specific bucket for crypto. It was new, it was weird.
Right.
So accountants looked at Bitcoin and said, well, it's not cash, not a stock, not inventory. So they shoved it into the bucket labeled indefinite-lived intangible assets.
Which is usually for things like trademarks, brand copyrights, like the value of the Nike swoosh.
Exactly. Think of a corporate logo. You buy it or create it, and it just sits on your books at cost. You generally don't expect a logo's value to fluctuate violently day to day. The logic is conservative, recorded at the price you paid. That's your cost basis.
Yeah.
And you just leave it there.
But Bitcoin isn't a logo. I mean, it trades 24/7 all over the world. It's highly liquid.
Right. And that's where the impairment trap snaps shut. Under those old rules, if the market price of Bitcoin dropped below your purchase price, even by a single penny for 5 minutes in the middle of the night, you had to impair the asset.
Impair meaning you have to formally recognize that it's worth less.
You were forced to write down the value on your books to that lowest market price and record a loss on your income statement.
Okay, that's harsh, but fair enough if the value drops. But here is where I always got stuck. If the price bounces back the next day or maybe doubles the next month, you just write it back up.
No. That was the kicker. That was a rule that drove people like Michael Saylor crazy. You were strictly prohibited from writing the value back up.
Seriously.
Once you took that impairment charge, that was your new baseline. The only way you could ever record a gain was if you actually sold the Bitcoin.
So it was one-way ratchet. You capture 100% of the downside volatility and 0% of the upside appreciation.
Precisely. It meant a company like Strategy Inc. could be holding Bitcoin worth $40 billion on the open market, but their balance sheet might say it's worth $20 billion because of some dip that happened 3 years ago. It created this massive distortion.
So investors couldn't trust the book value of the company. It was just completely divorced from economic reality.
It made the asset look ugly to anyone just glancing at the P&L. It signaled high risk with absolutely no visible reward. It basically told the market, this asset only loses money.
But that era is gone. As of fiscal years beginning after December 15th, 2024, we are in the fair value era. ASU 2023-08 is the law of the land. So walk us through the mechanics here. We aren't just impairing anymore.
No more impairment games. The headline is simply fair value. Companies must now measure their crypto assets at the current market price on the last day of every single reporting period.
So if Bitcoin goes up during the quarter, I book a gain.
Yes, and if it goes down, you book a loss. And this is the critical part. These are unrealized gains and losses. You haven't sold the asset. You haven't touched cash. But those paper swings flow directly into your net income.
Wow. That seems like it would wreak havoc on an earnings call. Your net income figure, the number investors use to judge the health of the business, is now tethered to the spot price of Bitcoin on March 31st.
It introduces massive noise. I mean, your operating business could be steady as a rock selling software, making widgets, whatever. But if Bitcoin rallies 20% in the last week of the quarter, your net income could double.
And if Bitcoin dumps 20%, you might post a huge loss, even if you sold more widgets than ever before.
Exactly.
Now, does this apply to everything? I mean, if a company's holding a bag of obscure NFTs or stablecoins or some token they invented themselves, are they marking those to market too?
No, and the FASB was very specific here. They wanted to avoid opening a Pandora's box of valuation tricks. So they set 6 specific criteria.
Okay.
To qualify, the asset must be an intangible on a blockchain secured by cryptography, and this is the big one, it must be fungible.
Fungible, meaning interchangeable. 1 Bitcoin equals 1 Bitcoin. 1 Ether equals 1 Ether.
Correct. So this explicitly excludes non-fungible tokens, or NFTs. I mean, how do you determine the fair value of a unique digital art piece every quarter? It's just too subjective.
And what about companies creating their own tokens?
The rule also excludes assets the company created themselves.
So I can't mint Talk Ticker's token, keep 1 billion of them in my treasury, and then tell the SEC I'm a billionaire because my cousin bought one for $5.
Exactly. They close that Enron-style loophole. It also generally excludes wrapped tokens and stablecoins, which have different characteristics. This rule is really laser targeted at the major liquid assets like Bitcoin and Ethereum, where there is a clear active market.
Okay, so the rules are set. Let's look at the guinea pig. Strategy Inc. They have been the loudest advocate for this change for years. They adopted the rule on January 1st, 2025. What happened the moment the clock struck 12?
It was an instant re-rating of their financial health. Because they had been aggressively writing down their Bitcoin for years under the old rules, their book value is artificially low. So on January 1st, they applied what's called a cumulative effect adjustment.
Which sounds as fancy accountant speak for fixing the error.
That's basically it. They increased their opening retained earnings by roughly $12.7 billion.
$12 billion. That is not a rounding error. That is the GDP of a small country just appearing on the balance sheet overnight.
It really shows you just how detached the old accounting was from reality. That $12.7 billion wasn't new money. It was value that was already there, finally being acknowledged by the ledger. It was a massive validation of their whole thesis.
But then, almost immediately, the volatility monster showed up.
Yeah.
Let's look at the Q1 2025 report. This is where the double-edged sword of fair value really cuts deep.
It's the perfect case study. In Q1 2025, after a massive run-up, Bitcoin's price slumped. It fell back to post-election levels. Under the old rules, Strategy Inc. would have just impaired the asset to the new low and moved on. But under fair value, they had to report the entire swing.
As an unrealized loss.
Exactly.
And the number was staggering.
They reported an unrealized loss on digital assets of $5.91 billion for the quarter.
Nearly $6 billion. Okay, so if you're a retail investor and you see a headline, Strategy Inc. loses $6 billion, you panic, you sell. You assume the software business completely collapsed.
Of course. But if you dig into the cash flow statement, you see the company didn't lose $6 billion of cash. It was a paper adjustment. In fact, here's a detail that confuses a lot of people. They actually recorded a $1.69 billion income tax benefit related to that loss.
Wait, explain that. How do you get a tax benefit from a paper loss that didn't involve cash leaving the bank?
It's related to deferred tax liabilities. Because the accounting loss reduced their taxable income projection on paper, it adjusted their deferred tax balance. It's complex corporate tax stuff, but the takeaway for you is that the net income line is becoming increasingly useless for valuing these companies. You have to look at cash flow.
It demands a much more sophisticated investor. You can't just look at PE ratios anymore. And speaking of Strategy Inc., we need to contextualize the scale here. We aren't talking about a company with just a few coins in the treasury.
No. As of March 31st, 2025, they held 528,185 Bitcoins. The fair value at that snapshot in time was $43.55 billion.
That's absurd. At that scale, the company isn't really a software company anymore, is it? It's a Bitcoin ETF that happens to sell some enterprise analytics.
The market certainly treats it that way. We look at a metric called beta. It measures how much a stock moves relative to an asset. Strategy Inc.'s beta relative to Bitcoin is actually greater than 1.
Meaning it's more volatile than Bitcoin itself.
Yes. It acts like a leveraged Bitcoin play. The correlation between the stock price and Bitcoin is about 94%. The software business provides cash flow to service debt and buy more Bitcoin, but the stock price is almost entirely a derivative of the crypto market. When Bitcoin sneezes, Strategy Inc. catches a cold.
So Strategy Inc. is the extreme outlier. But let's zoom out to the average CFO. The Treasury Reserve narrative, this idea that every company should hold some Bitcoin, has been pushed for years. Does this rule change actually move the needle for a normal company?
It removes the friction. That's the biggest change. Before, a CFO had to go to the board of directors and say, I want to buy Bitcoin. If it goes up, we can't show the profit. If it goes down, we have to declare a loss and look incompetent. That was a hard sell.
Right. Hey, boss, let's buy this asset that can only make our earnings look bad.
Exactly. Now, the pitch is different. We buy this asset. If it appreciates, our balance sheet looks stronger immediately. It's liquid. It's fair value. The friction of that ugly accounting is just gone.
And are we seeing interest?
We are. The data reflects it. The Deloitte surveys are backing this up. Nearly 1 in 4 CFOs say they expect to use digital currency in their finance function within 2 years.
That's 25%.
Yeah.
That seems incredibly high given the volatility we just discussed.
And for large enterprises, it's even higher, 40%. But, use is a broad term. It might mean accepting payments or holding a small amount. It doesn't necessarily mean they are going full sailor and converting their entire cash pile into Bitcoin.
Because the volatility is still the killer. If I'm running a manufacturing plant, do I really want to explain to my shareholders that we missed earnings because Bitcoin had a bad weekend?
That is the CFO's dilemma. Fair value brings transparency, but it maximizes noise. If you're a standard operating company, you want your stock to reflect your operational excellence, not the whims of the crypto market. It can actually depress your stock valuation.
Because investors see it as unnecessary risk. They could just buy Bitcoin themselves if they wanted to.
Right. And there are operational hurdles, too. It's not just buying it on an exchange. You need enterprise-grade custody. You need internal controls. You need software that can track all the different tax slots.
It's a heavy lift for the back office.
It is. You're essentially building a mini bank inside your finance department.
Now, Strategy Inc. seems to be trying to bridge this gap. I was reading about their Lightning Network push. This seems like an attempt to turn that passive pile of Bitcoin into an operating asset.
This is the pivot to watch. They are developing what they call a Bitcoin to Sats payment rail. The goal is to use their massive holdings and infrastructure to power transactions on the Lightning Network.
So instead of just waiting for a number to go up, they want to earn fees.
Exactly. Yield, routing fees, transaction services. If they can generate consistent operating cash flow from the Bitcoin ecosystem, it helps offset the volatility of the asset itself. It turns Bitcoin from a gold bar in a vault into working capital that generates a return.
The Holy Grail, a volatile asset that pays a dividend.
That's the dream. But it's early days.
Let's look at the global picture. We've been very U.S.-centric, talking about FASB and GAAP, but capital is global. How does this rule change affect how U.S. companies compare to their international peers?
Oh, this is huge for global capital flows. For a long time, the U.S. was the outlier. Under IFRS, that's the international standard which most of the world uses, companies often had the option to use a revaluation model for intangibles if there was an active market.
So a German or a Singaporean tech company could already mark their crypto to market?
In many cases, yes. Or at least they had more flexibility than the punitive U.S. model. This made it very hard for a global investor to compare a company in Austin versus a company in Berlin. Their balance sheets were speaking different languages.
So ASU 2023-08 is essentially a harmonization effort.
It brings American companies back into alignment, allows for an apples-to-apples comparison, and the new disclosure requirements are actually quite robust.
What do those disclosures look like? What am I actually seeing in the footnotes now?
You're seeing detail. Companies can't hide Bitcoin in a generic intangibles bucket anymore. It has to be its own line item. They have to list significant holdings individually. The name of the asset, cost basis, fair value, and number of units.
So if a company's trading in and out of it, trying to time the market, we'll actually see it.
You will see the churn. They have to reconcile the activity annually. What did they buy? What did they sell? What were the realized gains versus the unrealized gains?
And that distinction, realized versus unrealized, that's the whole game now.
It is. Realized means cash in the bank to pay dividends or buy back stock. Unrealized is just paper wealth that could vanish next quarter. You have to separate the signal from the noise.
This all feels like a growing up moment for the asset class. It's moving from the shadows of accounting anomalies into the main columns of the spreadsheet.
It legitimizes the asset in the eyes of corporate finance. It doesn't reduce the risk of Bitcoin. Bitcoin is still volatile, but it removes the risk that the accounting will lie to you about that volatility.
Before we wrap up, I want to pull on one loose thread. We talk about how these unrealized gains flow directly into net income.
Right.
Think about what that does to executive compensation.
Oh, that is the billion-dollar question. That's where the rubber meets the road for governance.
Most CEO and CFO bonus packages are tied to specific metrics. Hit $5 earnings per share and you get your yacht. Increase net income by 15% and you get your stock options.
You see where this is going? If I'm a CEO and I convince the board to buy $1 billion of Bitcoin, and we catch a bull run in Q4.
Your earnings per share skyrockets. You smash your targets.
And you didn't sell a single extra software license. You didn't innovate. You just rode a beta wave. You get a massive bonus just for being lucky.
And the inverse is true. You could run the company perfectly, cut costs, increase sales, but if Bitcoin crashes 30% in December, your EPS tanks and you lose your bonus.
It fundamentally breaks the traditional incentive structure. Boards of directors are going to have to rewrite these comp packages. Do you exclude crypto variance from bonus calculation?
You'd almost have to, right? Otherwise, you aren't hiring a CEO to run a business. You're hiring him to be a hedge fund manager.
And that brings us full circle. This accounting rule forces a conversation about what these companies actually are. If the treasury strategy becomes the primary driver of earnings, the CFO is no longer just a risk mitigator. They are an investment manager.
It's a fascinating evolution. We're watching the collision of traditional corporate governance with a highly volatile 24/7 asset class. And ASU 2023-08 is the rule book for the crash site.
It's going to be a wild few years of earnings calls. Investors need to learn to read the footnotes, ignore the headlines, and always watch the cash flow.
Sound advice. Strategy Inc. surely won't be the last company to post a multi-billion-dollar paper swing, and knowing the difference between paper loss and cash loss is going to be the difference between panic selling and smart investing.
Thanks for listening to Talk Tickers.